Hello and welcome. You're watching Closing Trades here on ET Now. The Nifty down around a third of a percent thereabouts. Some pressure creeping in. The possible positive from all of this is that we've seen a decently range-bound market yesterday. That too is holding up fairly okay in trade today as well. So we've not seen a major slip up per se. In fact, we've traded in around a 100-point band even in trade today. Yesterday was just a 70-point band. Today is a 100-point band. So between yesterday and today, essentially, we've traded in just about 150-point odd in terms of the band. It's not been a very large band we've traded in. Let's look at the Nifty and let's look at SBI in particular. It's one of the gainers of the day, 2.8% higher after those numbers came in. We've seen a bit of a spike on the stock price. But outside of that, TCS is up 3.1%. M&M, Grasim are just some of the other gainers on the Nifty today. Bajaj Finance is the key and top loser along with Bajaj Finance, both slipping 4 to 5% in trade. There's Trent, which is the other one, on the back of numbers which came in yesterday, but you had brokerage views coming in today, and therefore you're seeing some pressure on Trent as well. Shriram Finance is also the other one, 2.6% lower. Jio Financial is down around 2% as well. So that's the texture. In terms of sectoral, how sectors are behaving, you've got the Nifty Auto, which is up and away on the back of Hero, of course, being the key gainer within the Nifty Auto pack. But the Nifty Auto is up 1.7%, and Hero in particular is up approximately 3%. You're seeing Samvardhana Motherson as the other big gainer in trade today, 9% higher on Samvardhana. Sona BLW, Exide, M&M. I spoke about M&M as well, but Sona BLW and Exide as just some of the other contributors on the Nifty Auto Index. The Nifty IT is the other big gainer, and 3% odd higher is what we're seeing on TCS. Emphasis, LTM, HCL Tech are just some of the other gainers. No losers, frankly, within the Nifty IT pack. So you have a good tilt also in terms of the winners. The Nifty PSU Bank is the other one, and understandably so, just given the move in SBI. Therefore, that sector also is up around 1% now in trade. You've seen the Nifty India Defense Index continue doing okay. On the back of the gains yesterday, we've built on to those gains. The Fin Nifty is the top loser in terms of sectors, and Bajaj Finance and Finserv and Chola and Shriram are just some of the key drags. So it's all the NBFCs, especially the larger ones, which are contributing to the knock on the Fin Nifty. Outside of that, you're seeing a decent texture, 0.4% lower on the Nifty Bank, and despite that, we're holding up fairly okay in trade. When you're seeing, even in terms of the broader market action, flat on the Nifty mid cap and around a wee bit of a cut on the Nifty small cap, 0.25% odd lower on the small cap index. The Nifty 500, the advanced decline obviously is tilted in favor of the declines, but nonetheless we're in decent shape. It's not too badgered out of shape. 2:3 on the advanced decline broadly is what we're seeing. Last off, just some gainers and losers. Jyoti CNC is down 13%. There's Crompton, which is down 7% on the back of numbers. Bajaj Finance, FSL, which is First Source Limited. You've got EIH, which is the other one, 5.5% lower is what we're seeing on an EIH. SEM India, JK Tyre, just some of the other names which are trending in the red. Siemens Energy, on the other hand, fantastic set of numbers, and therefore you're seeing that move. Samvardhana, Tata Tech is up another 7% in trade today. Techno Electric and Devyani are the other big gainers. TFS, Sapphire Foods, it's all QSR, right? So that entire space is lit up in trade today. Let me go across to Kunal. Kunal, trends in the market that you're spotting today?
Yeah, it's an okay day for the indices, more or less like an average day for the Nifty as well as for the Bank Nifty. But the real action is happening, I think, within the breadth of the market, and in a few sectors which have actually managed to make a comeback. Auto anch names, I think after the last couple of days of a sideways patch, I think I've managed to make a very good comeback, right from two-wheelers, four-wheeler stocks, auto anch names, some of them which you highlighted. Hero MotoCorp, M&M, for example, has done reasonably well. And from the auto anch names, I think Samvardhana Motherson as well as Sona BLW, I think these stocks have done fairly well for themselves. Reliance, I think, has managed to just about eke out a little bit of more gains from where the stock left off yesterday. So that's another positive. Net, I would sense that we're just trying to consolidate from where we were over the last couple of days, but the direction and the bias still is on the upside.
Okay, bias on the upside. You've got SBI's margin number also, which has come in at 2.86%. That's the net interest margin for SBI. Of course, a little bit of a downtick on a YOY basis is what we've seen. I'll just quickly pull out the QOQ numbers as well. But the other one and the big one, the big mover in trade today is Bajaj Finance. It's plunged after an IIFL report highlighted the potential impact of the RBI's draft directions on revolving credit. According to the report, the proposed rules would effectively bar NBFCs and housing finance companies from offering revolving credit products. Mithali here to explain.
Right, so big news coming in from RBI that could actually reshape the unsecured lending space for India, and the Reserve Bank's draft directions, they have proposed that NBFCs as well as the housing finance companies, they no longer will be able to offer the revolving credit facilities, and instead they will be restricted to the term loans with a fixed repayment schedule and also non-replenishing credit limit, while the bullet prepayment loans, they still remain intact. But the key takeaway here is that the revolving credit will effectively become the exclusive domain of RBI authorized credit card issuers. Now, the market reaction was quite swift, and you see that Bajaj Finance has been under pressure since morning as it is the biggest loser. Now, according to IIFL estimates, Bajaj Finance's consolidated loan book, if you see, so 20%, 15% on the consolidated loan book and 20% of the standalone will get impacted due to these guidelines. And also Tata Capital faces a meaningful exposure, while Cholamandalam's exposure is below 1%, and also Poonawalla FinCorp, they are largely insulated. Now, according to IIFL, NBFCs could possibly adapt going forward by redesigning their products and also treating every fresh loan as a new loan, or maybe reduce some prepayment charges to protect their margins. But we will see as to how these final guidelines will roll out and how much impact will these NBFCs as well as the housing finance companies will be facing.
For that, Mithali, at least on charts, this one looks under pressure. Kunal, 6% low on Bajaj Finance at this point in time. How bad does the chart look?
Well, it doesn't look that bad because, the move which had happened for Bajaj Finance on the result day when the stock had gapped up, and I think the move started off from the stock being close to this 1,050, 1,060 levels, and from there it jumped up another 10% on the higher side. So that gap which the stock had created on the result day, it's just about coming closer towards bridging this gap or closing this gap. I believe that technically is still a positive for the stock price, because when you see generally closure of gaps, the stock intensity of the stock cools off and you see a stock coming back into a gradual uptrend. So maybe another 20 points on the downside further, but closer to 1,050, this could be a good bet for a contra buy.
The other big one is SBI, and Mithali is still with us to give us a perspective of how the numbers have shaped up. Mithali, margins, growth, key. Give us a sense of what it looks like.
Right, so overall a very strong set of numbers coming in for Q1 FY27, and they have actually beaten the street estimates in terms of profitability. Margins, yes, you correctly mentioned, that has improved on a sequential basis and is actually above the estimates that the street has penciled in of around 2.77%, but a quite moderation seen on an yearly basis, but still ahead of the estimates. Now, the profit after tax is up 10%, well ahead of the estimates, while the net interest income was largely in line. Also, if you see the operating profit, that has also exceeded the expectations, as the operating expenses for this quarter, they remain under control. On the asset quality side, performance remained quite strong, both on a sequential as well as on a yearly basis, while provisions, as expected, they have risen on a sequential basis. Talking about the business momentum, that has continued to grow in a healthy way, with advances growing to 18.6% on a yearly basis, led by retail, agriculture, SME as well as the corporate segments, while the deposits have grown by 9.7%. So overall, a strong quarter coming in for SBI, and yes, you can see that the streets are seen to celebrate the stock after the results.
Okay, thank you so much, Mithali, for that. Just in terms of the numbers, right? Your margin number has actually come off by 5 basis points. 2.91% was the margin number last quarter. It's come in at 2.86. So while that may be a negative, but the contraction was much lower than what the street was penciling in, as Mithali said, that number was at 2.77%, and therefore that contraction was lower than expected, which is a positive. The other piece is the slippages. Last year, and mind you, typically you take YOY slippages because there is seasonality to it. 7,950 crore is where that slippage number was in Q1 FY26. Currently at 7,046 crores. So despite the loan book growing, you've actually seen slippages come off. I think both of those numbers are being taken positively by the street. And of course, that 10% growth on a YOY basis on profitability is just the cherry on top. I mean, 21,000 crore now in terms of quarterly profit that SBI has clocked. So that's with regard to SBI. Kunal, very quickly on charts, do you have a view?
Yeah, I think it's been a better performing stock from the large cap banking names, but I would still believe that I think the stock needs to show a confirmation of a break above 1100 levels. Till the time it doesn't do that, I think it's going to be a bit tricky for SBI to try and sustain this uptrend. The only concern is that on the intraday charts, when the stock was hitting 11, 20, 25, it's hit some extreme ends of the Bollinger Bands, which could probably warrant some bit of a intraday cool off. So near-term chart patterns look positive, but I think closure above 1100 levels for SBI could probably dominate the near-term trend.
Okay, Kunal, thank you for that, and thanks for giving us that perspective. On to our next chat, as we await, of course, the SBI presser, which will be on stream any minute now. We'll wait for that, and we'll wait to hear from management as to what they have to say with regard to the numbers. But I'm guessing things look good, at least for the moment, from an SBI standpoint. But while we are at it, let me bring on board Gopal Jain, Managing Director and CEO at Gaja Alternate Asset Management, joining us this afternoon in studio. So I have the privilege of having him here. Gopal, great having you. Let me first start off, good afternoon. And let me first start off by understanding from you, what are the trends that are playing out currently in private markets? Let's start with that, maybe the 30,000 feet view, because a lot of times, Gopal, the public markets are slightly delayed in terms of the trend. You first start to see it in private markets and thereafter in public markets. So give us a sense.
Well, alternatives is the fastest growing part of Indian financial services, arguably. In the last 10 years, from a small base, alternatives have grown 43x in India compared to 6x for mutual funds and 2.5x for bank deposits. There are many trends. I mean, we can spend a lot of time discussing trends, but the trends that come to my mind are A, the emergence of deep tech, Indian deep tech as an investable sector. Second is the emergence of domestic pools of capital for Indian alternatives. And third is the rise of listed alternatives. Each of these are exciting trends which will shape the industry over the next 10 years.
Okay, Gopal, let's start with the first one, deep tech. And maybe I can club a little bit of AI as well on it and try and understand as to how the environment on ground is shaping up from an India standpoint. There are a lot of voices which are suggesting that India has been left behind in this race. What's your sense?
Well, we are not left, we are behind, but not left behind.
Okay.
As in many other cases, we will rapidly catch up. I'm absolutely confident that the stage is set for India to emerge as an innovation economy. Many years ago, India became an entrepreneurial economy. And a few years before that, I spent so much time listening to people that Indians don't have the entrepreneurial gene. We've proved the world wrong. I don't think the world is arguing against us, but you will see that a very deep, large innovation economy will emerge in India. The early signs are already there. It takes a lot for this to happen. There's funding that's required. There's entrepreneurs that need to come there. There is academia that needs to contribute. Then there's the market. But slowly and surely, and the good news is the government has taken firm steps. It's created funding capacity close to 10 lakh crores for deep tech. There are multiple missions, the space mission, AI missions, semiconductor, RDI. Similarly, there is a group of investors that have come together. IDTA, for example, we are one of the founding members that have committed capital to invest in Indian deep tech. And there's a growing number of Indian entrepreneurs that are looking at various aspects of Indian deep tech, of which AI is, of course, one sector, one subsector.
You invest in various sectors, and of course, tech is one of those. Then there's financials. There is consumer broadly. Those are the three broad segments that you target, Gopal. And therefore, you stand at an important confluence. You're a capital allocator and you understand tech very well. Tell us, especially from an IT services standpoint, how disruptive is the technology that you're seeing and investing in?
Well, right now, the understanding around AI is emerging. AI is a 5-layer cake. And IT services companies have a role to play in one of these layers, at the layer of applications, the layer of implementation. And so I know there is an argument here, but I'm a big believer in how Indian IT services and Indian IT service companies will adapt. And they will, and there is a huge commercial opportunity here. There are the foundational models and there is everything else, but AI has to be harnessed for it to deliver productivity gains to enterprises. And that is the role of a layer of companies that are at the application level, at the implementation level. That is a role that Indian IT service companies can possibly play.
You know, typically when we see large disruptions, Gopal, you rely on the 80-20 rule that out of the 100 participants, 20 will take a bulk of the upside from big changes that happen. Do you believe that we are at that sort of an inflection point that you'll have to pick and choose the people or the investments that you make, or will it be very, very broad based in terms of that insofar that pretty much all the current players will largely adapt and succeed?
Well, in addition to that, there is also what happens is that whenever there is dramatic transformation, there is a new breed of companies. So it becomes a little more complex. There are some that are left behind. There are some that adapt, and there are some newer generation companies that emerge. I won't take names, but we ourselves have made a bet on one such company, which is more an AI services company. I think time will tell. I mean, there is a lot of uncertainty and a lot of questions, apprehensions. There's a lot of market value, I know, in this sector. But this is a well-capitalized sector. It's got a repository of capability and caliber. So I think we should see how this pans out.
You know, the other big one is alternatives, Gopal, and I'm going to be very, very curious to understand as to how that story is evolving and emerging, and how listed alternatives are actually behaving in your opinion, especially from a valuation standpoint and otherwise. How are they being accepted? But you know what? I need to take a small commercial, take a bit of a breather, come back and chat about that with Gopal Jain. Stay with us. Welcome back, and you're tuned in to Closing Trades here on ET Now, and we're live with Gopal Jain right alongside me. And Gopal, we were speaking about the alternative story, right, in India, and now we've got a fair bit of depth in the alternatives market, at least on the listed side of things. On the unlisted side of things, you too have plenty of experience within the domain, of course. But give us a sense as to how you're seeing the entire space evolve and how capital allocation towards these alternatives in terms of what are the trends that are playing out in terms of capital allocation in this space?
Well, we spoke about one major trend, which is the emergence of Indian deep tech as a sector to invest in. And as I think about other trends, the second major trend that comes to mind is the emergence of domestic pools of capital for alternatives. You know, for the longest time, Indian alternatives were financed by global investors alone.
Yes.
Now we are a large economy, and Indian alternatives need domestic pools of capital.
Right.
The plumbing is broken, but the plumbing is being fixed. And in this particular case, the government is doing an excellent job.
Okay.
Recently, you must have heard about the NPS setting up a fund of funds portal.
Yes.
That's a massive pool of long-term capital that can shape the future of Indian alternatives. Similarly, Indian banks have been allowed. Indian insurance companies have been allowed. And as domestic, we are a savings capital of the world. We are 4% of the global economy. We are 7% of global savings. But these savings currently don't flow into alternatives. This is one major trend. The second major trend is the rise of listed alternatives. By that, I don't mean companies that alternatives invest in and then that going public. By that, I mean things like REITs, things like InvITs, which are permanent capital vehicles that own assets, and at some point of time, alternative AMCs.
Right.
So if you look at the proven playbook in the West, I mean, listed alternatives have mainstreamed alternatives. So Indian alternatives, may I say, have so far been a niche sector. If you want to see how they emerge as a mainstream sector, in a way like how SIP mainstream mutual funds, listed alternatives, mainstream alternatives.
Right. But how quickly do we get there? And of course, it's a journey, and maybe it takes a decade from here, but we'll get there. Just talk to us about how quickly do you believe we can get there? Two, from a regulatory standpoint, what else can be eased? For example, investor disclosures, and the like. What can be done which should enable this?
Well, one of the reasons India gets a premium globally is because of excellent regulation. And I would say alternatives itself has been a huge beneficiary of excellent regulation.
That's true.
And I'm part of IVC, and as part of IVC, I can tell you that we have an excellent engagement with the regulator. And the regulator does think about what does the industry need to go from here. The industry is very ambitious. As I said, from a small base, it has grown 43x. Now, from this base, it wants to grow 6x. That will take us to roughly $1 trillion of AUM in India alone.
Correct.
That's a big number, right?
Yes.
It's roughly where the mutual fund sector is today. And for that to happen, you need domestic pools of capital. You need next-gen regulation. And you need, may I say, listed alternatives also.
So where are the gaps?
Many of the gaps are being plugged. But like I said, broadly speaking, the big focus right now is building the plumbing that connects our large pools of savings to Indian alternatives. I mean, so that fund managers don't have to travel around the world like we did 20 years ago to raise a fund, right? And don't have to constantly worry about A, what the dollar and the rupee are doing. B, the world sneezes and India catches a cold. Look at our public markets. When there were only foreign investors in public markets, we were so coupled to global trends. Now we have an independent direction of our own, right? This happened over the last 20 years. Look at GFC and look at how we have weathered recent storms.
That's true.
Something similar needs to happen there. But there are some other issues which only listed alternatives can solve. And what are those? Things like liquidity, things like access. 99% or maybe 90% of institutional investors and retail investors find it difficult to invest in AIFs. And they will always find it difficult to invest in AIFs, lack of liquidity, transparency, etc. This is where things like InvITs and REITs really play a role. And at some point of time, alternative AMCs will also play a role.
Got it. And with regard to investor awareness, because when you don't understand something, you're typically scared of investing in it. Right. You believe enough has been done from an education standpoint to try and enlighten investors about these avenues of investing?
Much more needs to be done, and much more is being done.
So maybe that's one of the bottlenecks.
That's one of, absolutely. It's a complex product.
Yes.
Alternatives are required because of longevity.
Correct.
Humans are living longer, Indians are living longer. 125 years ago, the world's life expectancy was 32. At the time of independence, our life expectancy was 32. Today, it's 75 for the world and 75 for us. People need savings, people need to save through equities, and people need to save through alternatives. But alternatives are complex products.
Absolutely. Okay, Gopal, I'm going to have to cut this short, but thank you so much for coming in. It's been a wonderful conversation. And viewers, I need to cut across. We have the SBI chairman speaking.
Media to this important gathering. We are here today to share the financial results of State Bank of India for the Q1 of the financial year 27. It's my privilege to welcome on the dais our esteemed chairman, Shri Challa Srinivasulu Setty sir, and our respected managing directors, Shri Ashwini Kumar Tiwari sir, Shri Rana Ashutosh Kumar Singh sir, Shri Rama Mohan Rao Amra sir, and Shri Ravi Ranjan sir, along with our Deputy Managing Director of Finance, Shri A.S. Paul sir. I also extend a warm welcome to the Deputy Managing Directors and senior officials of SBI who are present with us this afternoon. We sincerely appreciate your graceful presence. आपकी आभामयी एवं गरिमामयी उपस्थिति के लिए कुछ कवितामयी पंक्तियों के साथ आपका स्वागत करना चाहूँगा। तिमाही गुजरी हर कोशिश कमाल है, तिमाही गुजरी हर कोशिश कमाल है, इरादे बुलंद हैं, प्रॉफिट बेमिसाल है, बिजनेस बेमिसाल है, नतीजों की इस खूबसूरत
We'll cut straight back to that SBI presser, but essentially the stock is perked up 3% and you're seeing some very decent moves on the back of the numbers that SBI has clocked. It's a solid set, 2.3% QOQ growth, 18% YOY growth on the loan book, even though CASA hasn't grown much. And that seems to, in some form or shape, impact margins. We'll go straight across as and when Mr. Sethi starts speaking. In fact, let's cut across. I believe, okay, so we'll just cut across as soon as he starts speaking and we'll get a sense of what he's making of the SBI numbers and what we can expect. Okay, we'll continue to monitor that SBI feed. Okay, let's go across.
Every quarter provides us with an opportunity to present our financial performance, but more importantly, it allows us to share the strategic direction in which the bank is moving. We have always believed that beyond numbers, quarterly results are also the outcome of sustained investments in people, technology, customer relationships, and prudent risk management. Before I take you through the highlights of our last quarter performance, I would first like to share our perspectives on the evolving economic environment and the initiatives we have undertaken to position the bank towards a sustainable long-term growth. The global economy continues to operate in an environment of heightened uncertainty. Geopolitical tensions in West Asia remain a source of volatility, while renewed trade measures by the United States have added another layer of uncertainty to global commerce. Crude oil prices, exchange rates, and financial markets continue to respond sharply to geopolitical developments and changing global expectations. Against this backdrop, India's economic resilience continues to stand out. With respect to the banking sector, credit growth has accelerated across key sectors, supported by healthy demand from retail, MSME, agriculture, and industries. Capital adequacy, liquidity, and asset quality across the banking system continue to be remaining comfortable, although some moderation in margins has been witnessed across the industry. Overall, the Indian economy has performed better than expected during the first quarter, and we remain confident about its medium-term growth prospects. At SBI, our strategic direction continues to be guided by a simple philosophy: digital first, customer first, and nation always. These guiding principles shape every investment we make and every initiative we undertake. During the quarter, we continue to simplify banking by expanding our flagship operations process re-engineering project called Project SBI, with the objective of making customer journeys faster, simpler, and more convenient. One important milestone has been the launch of our digital re-KYC journey, enabling eligible customers to complete KYC updates through a seamless digital interface. We have also continued to strengthen the YONO ecosystem by introducing new digital journeys. Customers can now open a savings account along with a demat and trading account through a single onboarding process, further aligning our digital platforms in line with changing customer aspirations. We are adopting artificial intelligence in a purposeful and responsible manner across all facets of banking. During the quarter, we introduced YONO G, an agentic AI-powered virtual assistant on YONO Business to provide our commercial clientele with round-the-clock support. We also expanded WhatsApp banking services to our current account customers and strengthened the digital capabilities of YONO Business by integrating our trade finance suite, including the use of artificial intelligence in trade finance operations. Our efforts to improve credit delivery is a continuous journey. We have extended our business rule engine, MSME Dream, to cover SME loans up to 10 crore rupees, enabling faster and more consistent credit decisions without compromising underwriting standards. In agriculture, we have expanded digital document execution across the nation for Kisan credit card and Agri Gold loans, thereby reducing turnaround time and improving customer convenience. Technology is equally transforming the way we manage risk. Through Project Prism, our predictive stress monitoring platform, we are leveraging internal and external sources to identify early signs of stress in borrower accounts. This strengthens our ability to take timely corrective action. Our objective is to remain proactive in preserving asset quality. Collectively, these initiatives are helping us build a future-ready institution. Coming now to our key numbers, I am pleased to share that our net profit for the quarter stood 21,121 crore rupees, registering a year-on-year growth of 10.23%. Our operating profit increased by 9.77% to 33,529 crore rupees. Return on assets remained healthy at 1.11%, while return on equity stood at 17.87%, comfortably above our long-term guidance for the last 16 quarters. Our operating efficiency also continued to improve during this quarter. Operating expenses remained well contained, leading to further improvement in our cost-to-income ratio. Our domestic net interest margin improved sequentially, reinforcing our confidence in maintaining our guidance of 3% for the financial year. Our balance sheet continues to expand on the strength of customer confidence. During the quarter, our total business crossed 110 trillion rupees, with deposits exceeding 60 trillion rupees and advances crossing 50 trillion rupees. Our domestic business has grown by more than 11.6 trillion rupees on a year-on-year basis, while our overall balance sheet has crossed 76.6 trillion rupees. Deposit mobilization remained healthy in an intensely competitive environment. Total deposits registered strong growth of 9.73% year-on-year, supported by robust growth in retail term deposits as well as savings bank deposits. Our CASA franchise continues to remain among the strongest in the banking industry, reflecting the enduring trust that customers place in SBI. Our overseas operations recorded healthy growth in deposits. Credit growth remained broad-based across all major business segments. Agriculture, MSME, corporate, and retail advances all recorded double-digit growth, while our RAM portfolio continued its steady expansion with a year-on-year growth of 18.2%. Our overseas operations delivered healthy growth in advances, having grown at 21.38% in rupee terms, underlining the diversified nature of our franchise. One of the most satisfying aspects of our performance continues to be the sustained improvement in asset quality. Our gross NPA ratio has declined further to 1.47% and is now at its lowest level in more than 2 decades. Net NPA at 0.38% and credit costs at 0.27% have also improved, reflecting disciplined underwriting, effective recovery mechanisms, and continuous strengthening of our risk management processes. Our provision coverage ratio at 74.2% remains robust, providing additional resilience to the balance sheet. The bank also continues to remain well capitalized with capital adequacy and CET1 ratios comfortably above regulatory requirements. This provides us with sufficient headroom to support future credit growth while maintaining a strong capital position. Digital transformation continues to be one of the defining strengths of SBI. Today, the overwhelming majority of customer transactions, almost 99%, are conducted through.
All right, that's the chairman of the State Bank of India, and that's on the back of the numbers they've come out with. You can obviously be updated with regard to everything that he's saying. Flashes will come at the bottom of the screen as and when he says or provides his guidance. Secondly, we'll cut across to him, of course, as and when he says something which stands out in terms of commentary. But let's quickly move on. Siemens Energy is the other one. A strong first quarter reported, profitability beating estimates despite a slight revenue miss. Brokerages retained their positive stance, citing the kind of margin strength that was shown and the execution that was shown. Sunidhi here with the highlights.
Siemens Energy India reported a strong Q1 for FY27 with EBITDA and profit numbers comfortably beating the street's expectations despite revenue coming in below the street's estimates. Revenue grew by 13% YOY, while EBITDA surged 72%, while the company's EBITDA margins reached a point of 23.6% for the company during the quarter, while its profits jumped 68% year-on-year. Growth was broad-based across both businesses of transmission and generation. Power transmission revenue increased by 42% year-on-year, while power generation grew by 36%. This highlighted healthy demand across the power sector. Following this strong performance, Motilal Oswal maintained its buy rating and raised the target price to 4,100 from the earlier 3,950, while Nuvama also maintained the buy rating and raised the earnings estimates while reiterating a target price of 4,200, citing faster execution across the business and sustained margin strength. Overall, it was an impressive quarter for the company. While revenue did miss the expectations, the sharp margin expansion and strong earnings growth more than made up for it. This has reinforced confidence in the company's long-term growth outlook.
Okay, all right. Thank you so much for that, Sunidhi. We'll slip into a very short break, come back. We'll be joined by Rajesh Palvia. Kunal Bothra still with us, but we'll be joined by Rajesh as well. We'll quickly start taking views. Of course, we'll have one eye on the SBI presser. There's Hindalco's numbers flashing on your screen. That 4,784 crore profit looks far stronger than expected, even though revenue looks like a bit of a miss versus estimates. 35,000 crore is where the top line number was expected in at. It's coming at 30,000 crore. The EBITDA number has come in just shy of 7,000 crore rupees. Broadly, that's the texture. Margins at 23%. We'll take stock of that as well on the other side. Stay with us. Welcome back, and we're joined by Ashesha here with a sense of how Hindalco's numbers look. Ashesha, looks like a soft top line, but a beat on EBITDA and PAT. Give us a sense.
Well, yes, indeed. Revenues have come in line, or rather below what the street was working with. But otherwise, if you look at the margins and EBITDA, that clearly is a big beat as compared to what ET Now poll was throwing up. EBITDA, in fact, has come in at about 6,985 crores versus 5,100 crores that the company had reported in the previous quarter. Now, remember, for India operations, aluminium prices have risen on account of West Asia concerns, and that aided numbers in the quarter gone by. We'll try and get in aluminium and copper segment EBITDA individually as well in a bit. But for now, standalone EBITDA for India operations is much ahead of what the street was working with. Margins, meanwhile, have also expanded a whole lot. They've come in at about 23% now versus 15% that the company had reported in the previous quarter. Yes, raw material prices have also risen, but aluminium prices have more than proportionately risen, which is why realizations have likely gone up, and that is exactly why EBITDA has come much ahead of what the street was working with, and even on a sequential basis, it's a big beat. Now, remember, Novelis, which contributes about 70% of its revenue, had already reported its numbers 2 days back, and the numbers were very good. Novelis EBITDA per ton also shot up by 4% on a sequential basis, so that was one positive. And the management commentary that came in from the con call of Novelis was also very positive, where management says that EBITDA per ton of $600 is likely achievable in the near future. So Novelis was strong. Hindalco top line is a bit soft, but otherwise, if we look at the overall numbers, whether it is EBITDA or margins, they clearly have stood out and much ahead of what the street was working with.
Okay, all right. Ashesha, thank you so much. That's on Hindalco. Stock choppy, but now up 1.8% odd. So firmly in the green now is Hindalco. Let me, though, welcome on board Rajesh Palvia of Axis Securities, Ashi Anand of IME Capital, Kunal obviously with us. Well, it's a packed house, folks. Let's start. Rajesh, let me first start with your Nifty call and what you're seeing on the index.
So, yeah, good afternoon, Harsh. So Nifty
Good
is
afternoon.
volatile as heavyweight numbers are, coming. So Nifty is in range only. Looking at the overall structure, 24,500 is acting as a support, and it's still Nifty not able to take out 24,650 on a decisive manner. So I think we may see some more consolidation in this range only. Any breakout about 24,650 can attract more short covering, and then possible extension of really towards 24,800, 25,000 we may see in the coming week. Overall structure is bullish. Broader market is showing sign of confidence. So I think one should remain on the long side of trade, and possible higher side breakout we could witness in the coming week. Bank Nifty is still shying to cross major supply zone of 58,100, 200, which is major call writer zone. So once we able to take out those levels, then only Bank Nifty can show some more uptick. As of now, stock specific action is taking place on the banking space. So I think one should be stock specific, especially in the banking basket at this juncture. But overall, one should remain on the long side of trend. We believe that, in the coming week, we could see a breakout on the higher side.
Okay. How are you looking at, a couple of the big buzzers today, Rajesh? Bajaj Finance, first off, just the moves, and the entire NBFC pack, in fact, looking like it's under a bit of pressure. How should one position themselves? Is this an opportunity? Maybe go out, buy on dips, or not really?
So if I analyze the Bajaj Finance, we have seen a strong rally, but today's fall is now again, taking a major supply pressure, and now stock is trading around 20-day moving average, which is at around 1075. So 1075 one needs to keep as a stop loss if you are still holding the position. If it's break below 1075, maybe we could see further more supply pressure to piled up, and then stock can slide further to 1040 level also. So at this juncture, one can wait for this 1075, how this level pans out here. If it's hold, I think some pullback we may see in this counter, as overall short to medium term structure is still holding the strength. So we will wait for that level to how it's played out.
Ashi, let me come to you. Some of these NBFCs, there has been a run up in the prices of stock prices, and they've given good returns. Do you believe that this is just a sort of a healthy correction, or would you be worried with regard to the draft norms that have been released by the RBI, which discourages the kind of revolver credit kind of business models that some of these NBFCs operate?
So I think at least a large amount of the NBFCs that we really look at, especially the larger NBFCs, I don't think the revolver credit really is that significant an issue out there. I think on NBFCs, you obviously have to be quite particular about the specific kind of company that you're looking at, because each of them are kind of catering to separate kind of micro parts of the overall economy. In this entire in this current environment with kind of El Nino and kind of monsoons being relatively weak, I think anything which is semi-agri facing, anything microfinance related, some of these may just be areas you would be a little careful about in a kind of an environment where monsoons are a bit under pressure. I think the other element is US Iran and kind of what's happening on oil prices. That could also, if that kind of sustains over a period of time, may end up having some kind of level of concerns around vehicle finance. So there are certain important trends over and above just RBI and revolver credit that could have implications. But that said, I think we are hopefully in an economy which is starting to kind of see signs of a recovery. Obviously, the US Iran and oil prices are a big overhang. But if you are seeing the economy starting to come back, that should kind of aid credit growth, margins, etc. And I think which is where there is a certain level of bullishness across kind of financiers, not just NBFCs, but also banks.
Take a bit of a breather, slip into a short break, come back, talk more, plenty to speak about. There's cap goods, and there are some movers coming in. Bharat's defense, the earnings have come through. We'll try and decode some of those pieces of data coming our way as well. Stay with us. Welcome back. Let me go across to Avi. He's here with some of the stocks that are buzzing in trade. You want to keep on your radar. Avi, what do you have on your list?
So let's have a look at some of the stocks that are buzzing in trade, starting off from Motherson, which has come out with its Q1 FY27 results, and the numbers are really good with the revenue, EBITDA and PAT, all the parameters being above the estimate than what the street was estimating. The EBITDA margins also came in at 11.7%, which is above the 11% guidance given by the management earlier. They have around $96 billion of order book and will steadily inch up their dividend payout ratio up to 40% by FY30. So these are the triggers for Motherson. Up next is Wakefit, that is also seeing some buzz in the trade as the results have come and the revenue is up 16% with EBITDA up 28% and the margins also expanding by more than 1% for Wakefit. Talking about the profitability, it has come in at 23 crore rupees, which is a 21% increase on a YY basis for Wakefit. Up next is Hero MotoCorp. So the street was estimating around 13.1% EBITDA margins given the commodity inflation caused by West Asia crisis, but the numbers came in 20 bips higher at 13.3%. So a very strong set of numbers from Hero MotoCorp with the revenue in line, but the EBITDA and PAT clearly being a beat and what the street was estimating. The PAT is up 29% and the EBITDA is up 25%. The margins also have declined sequentially and YOY, but they're above than what the street was estimating. The volumes are also very good for Hero MotoCorp that saw 23% growth on a YOY basis at 16.77 lakh units. Up next is Signature Global, whose numbers are weak for Q1, and that is the reason the stock is seeing some selling pressure. The street was estimating around 800 crore rupees of top line, but came in at 552 crore rupees and was estimating a profit of around 60 to 70 crore rupees, but reported a loss of 16.5 crore rupees. So those are the reasons that led to the stock being under selling pressure today, and Signature Global out with weak numbers. Our last pick would be Ixigo, which has also posted weak set of numbers, and that is the reason the stock is down by almost 10%. Although the revenue and PAT is in line, but there is a clear miss on the EBITDA and the margins as well. The revenue was up 13%, the EBITDA came in down at 4.5% at 24.5 crore rupees. The PAT was up 71%, but the margins contracted sharply by 124 bips, coming in at 6.8%. So these were the stocks that were buzzing in trade. The auto sector stocks are also buzzing, with JK Tires down by around 5% and Jyoti CNC also down by around 10%.
Okay, all right. Ixigo is one of those that you've picked, Avi. What I'm going to do is quickly, cut across to the conversation that we had with Alok Bajpai. He's Group CEO at Ixigo, who remains bullish to achieve the #1 spot in the mid-market budget hotel segment in the next 4 to 5 years. Listen in.
Flights business, which for us is the largest by GTV at this point, right, was growing at 27% on GTV. Historically, it's grown faster, but because the volume growth this time has come in only at 4%, which is still the fastest in the OTA category, because most OTAs have actually degrown on the flights business this time around, but we managed to grow 4% there. Yeah, the hotels business is the one that I'm the most bullish on over the next 4 to 5 years, right? I believe this will be our strongest growth driver. Last couple of quarters, it's been the fastest growing business from a GTV perspective. We have made significant investments, not just by acquisition of Devi Stay, but also in our own organic approach to it. We have added direct supply, more than 10,000 properties we've signed up directly, and we are adding thousands of properties every quarter. And in total, we now have 70,000 plus properties in India, 1 million plus globally that we started selling on our platform.
All right. Okay, so that's on Ixigo. Ashi, how do you look at some of these companies? You know, online travel is not something that we speak about often, but you have a strong understanding of tech. How do you look at this cohort of companies?
Sure. So actually, I think fundamentally, while we do like and we are very bullish about platform businesses, one of the key elements about platform businesses is that the tech platform that has been created is connecting kind of participants of multiple sides. Now, the more disintermediated both sides, the kind of participants are, the stronger the platform. Now, therefore, when you're kind of looking at OTAs, we actually look at the flight versus the hotel business quite differently. The flight business, while yes, there are a large amount of consumers, which is one side of the kind of the platform, there's a high level of concentration when it comes to kind of the suppliers. There are only 2 or 3 primary kind of flights which are airplanes which are there now. Effectively, that kind of can really squeeze margins quite significantly. And if any of the low cost providers choose to kind of get out of OTA platforms or reduce margins there significantly, that part of the business can be under quite a lot of pressure. Which is where when we kind of look at OTAs, we actually look at it quite closely from a lens in terms of how strong is the hotels part of the business, because that is really where even on the supplier side, there is a large amount of diversification that allows OTAs to actually negotiate much better margins. The margins are a lot more sustainable. And also what happens is that the reviews and the experience around hotel discovery is can be differentiated a lot more as compared to the flights business. So when we do look at OTAs, we do like the space, but we're not very actively, we don't invest very aggressively, because We're slightly concerned about the longer term economics of the flights part of the business, but as OTAs kind of build out the hotels part, that actually is quite interesting and appealing to us.
Okay, and Ashi, I wonder how you look at some of the ER&D names as well, and what's the view there? Because you've seen plenty of choppiness in the stock prices. You saw very large corrections, and thereafter we've seen a bit of a run up in those. How is AI going to likely impact those particular pockets?
Yes, so actually that's actually quite interesting, right? Because the impact of AI on IT services, I think, is at least clearer that there is likely to be quite a substantial impact on IT services. The key question is, do you get incremental kind of volumes to take into account the deflationary impact that AI is clearly bringing into the space? So that is at least the call there is a bit clearer. When it comes to ER&D, at least as of right now, it does not seem that AI would have the same level of deflationary impact, simply because I think AI is a lot more advanced in terms of being able to code as compared to doing complex kind of ER things and other such services that ER&D companies specialize in. But if you look at the kind of way and the movement that is happening in AI, and if you kind of look at video generation, image generation, voice generation, etc., multimodal forms of communication that AI is being able to generate, one can kind of envisage a situation where you start seeing very competitive models of AI, which could also have a similar kind of a deflationary impact on ER&D. Our current view on ER&D is that there may be some kind of an impact, but it's likely to be substantially lower than that of IT services. And therefore, if these companies also fall in line with IT services because of concerns on AI's deflationary impact, that may actually present an opportunity. But one does really have to quite closely watch how the kind of tools that develop around artificial intelligence and ER&D, because that is really going to be the call about the longer term view on valuations in the space.
Ashi, stay with us. Lots more to talk about, but let me quickly bring on board Darshita as well. Tata Technologies has issued a clarification after its shares rallied for a second straight session on reports that Honda had outsourced a new vehicle development program to the company. Darshita, what's the clarification like?
Right. One stock that is in focus today is Tata Technologies. Now, the stock had rallied sharply yesterday following a 6.3% jump after a media report suggested that Honda had outsourced the development of a new vehicle program to the company. Now, investors viewed this as a positive development for Tata Technologies. But here's the clarification which has come in just today. The company says that this is not a new information. According to Tata Tech, the vehicle development program from a Japanese OEM was already disclosed in its Q4 FY26 earnings release and was reiterated again in Q1 FY27 results. The company has also clarified that it has not confirmed the customer is Honda. In fact, it says that it cannot disclose the identity of the customer due to its contractual and confidential obligations. Now, following this clarification, the stock has given up some of the gains in the trading session today, and we are seeing slightly correction in the session as the investors now reassess whether the news has genuinely new or already been priced in.
Okay, but Tata Technologies, the stock still holding on to those gains of another 8% in trade today. We'll take a very quick break. We'll come right back and we'll continue our market conversation with Ashi Anand and Kunal Bothra. Back with closing trades right here on 18 hours. Samvardhana Motherson, can't take your eyes off from that stock, can one? Almost headed in for a 10% uptick on the futures. That's where it's shutting shop for the week. In fact, auto INCs have really been one very strong pocket. Look at a Sona Comstar as well. After, I think, a day's break yesterday, it's back to that 3.5% gain. But talking about Motherson, you know, that came out with its numbers, and earlier today we did speak with the management about the quarter gone by, and let's hear out what they had to tell us.
You're absolutely right. This was best ever performance in the history of the company as far as revenue is concerned. The most of the top line has come from organic. The two acquisitions which you talked about, Utaka, as well as Nexans, these were consummated in the month of July. And from the second quarter of this financial year, these businesses will be consolidated and reported as part of Motherson Group. You're right. Our stated objective as Project 2030 is that we would like to increase our dividend payout ratio to up to 40%. Between fiscal 25 and fiscal 26, we have already improved it by almost 1 percentage point. And in times to come, depending on the state of the affairs, we'll try to further improvise to meet our guidance.
Okay, all right. So that's the take coming in. Let me also quickly have Kunal's view. Kunal, a couple of big buzzers today, including the likes of Samvardhana Motherson. What's the view on that one on charts?
Continues to be positive for auto anch names. I think Samvardhana Motherson has now charted a fresh lifetime high, breaking past about series of previous major highs, and the indicators on the long-term charts, of course, start to look a lot more positive for Samvardhana Motherson. It's just that after 8, 9%, 10% kind of an up move, it becomes very difficult for short-term traders to try and go for a buy. So that's why I would not recommend a buy for a fresh trade at the current levels. But for someone who's holding on to the stock from the lower levels, can continue to hold on to the trading stop loss.
Right, okay, that's the take coming in on what one is seeing on Samvardhana. But Ashi, hi, afternoon. Wanted to get your sense in the high frequency data indicating extremely strong demand still for Motown. Either auto majors or auto anchs, anywhere where you think there is still an opportunity after the run-up that has taken place.
Yeah, sure. So I think it's important to understand that there are a few important drivers of the kind of optimism you're seeing around auto. The first is obviously the GST cuts have been quite considerable, and that has kind of clearly made the cost of auto purchase considerably cheaper. This in the context of the kind of fact that demand had been quite subdued for a few years because of higher interest rates. So this combination of kind of falling interest rates, income tax cuts that happened earlier last year, GST cuts, a planned kind of pay commission, all of these are kind of supportive of an overall kind of an auto recovery. And I think that is what you are kind of seeing in terms of actual kind of numbers, on-ground demand, as well as kind of stock prices, which are doing quite well. So yes, we do also have certain exposures here. Our exposures are in something in M&M, where the EV part of the business and the SUV part of the business is also doing quite well. But I think across the board, most parts of auto, you are seeing kind of positive traction. It's just interesting to see how long this can sustain because, like we've been kind of mentioning even earlier, US-Iran monsoons, these are kind of important concerns. Oil prices do need to come down. As long as kind of oil prices do come down and monsoons do start to pick up, I think this kind of positive momentum could potentially sustain.
Side of Samuel though, Kunal, any further opportunities, auto anchs or autos?
So I think, Sona BLW is something which continues to look attractive, and specifically after yesterday's, I think our 40-50 point correction from 830 levels to 780 thereabouts, the stock has almost tried to recover and come back towards 815, 820. That's something which continues to look attractive. On the auto OEM space, I would look at M&M. After today's move, the stock is nearing a breakout back again of the previous resistance around 3,500 levels. It's also nearing very close towards its 200 moving average breakout. That could be another stock which traders could look at a buy because once the stock generally confirms a breakout, then we look at least another 3 months to 6 months of a potential trending upside for this stock. So this means that there could be a higher chance that the stock may come back towards 3,750, 3,800 levels potentially in the next 4 to 5 weeks.
What else from auto looks good, Kunal? How does Hero look now at 5,700? You were positive with regard to Hero at sub 5,000. We've seen a decent move up on the stock price.
Yeah, again, I think continues to look attractive, but the only catch over here is that after yesterday's price correction, today's rally, it looks like that the indicators are into a bit of a stretch on the intraday charts. There is some divergence which has been formed for Hero MotoCorp on the RE time frame. So near-term wise trends, the stock has been fabulous because from a sub 4,000 levels, the stock has moved towards almost 5,700 in a matter of 10 days, 12 days approximately. And now I think at 5,700, I would probably suggest that traders who've bought on from lower levels, I think it's a good time to try and book some profits out and then wait for a correction to try and dip into the stock again.
Okay. Consumption, Kunal, how is that pack looking? And should you place fresh bets at this point in time?
So Nestle is the only chart which has been looking very strong and active. In fact, today the stock has managed to show signs of slight bit of a recovery, coming back above the 1500 levels. And also, I think, retesting the previous highs the stock had made, I think, a week or two back around the 1550 mark. But then most of the other stocks, when you look at the charts, whether it's Dabur, whether it's Britannia to a larger extent, Tata Consumers, HUL, I think most of these stocks have gone through a decent correction. So not be too much keen into this space, frankly, but I think if I have to pick and choose maybe a stock from this pack, then I think Nestle could be the best bet so far.
Okay, that's that on consumption, but consumption also brings you to QCOM and some of the other urban niche consumption plays as well. Ashi, wanted your thoughts on Eternal Swiggy. For Swiggy, of course, the results were more mixed. For Eternal, the quarter was equally strong on the Blinkit side as also the food delivery side. Where now between Swiggy and Eternal do you find still opportunities to add in?
So I think it's quite clear we see opportunities in both. It remains, according to us, one of the most interesting kind of platform bets that is there. Food delivery and kind of quick commerce is a multi-sided platform combining kind of consumers, either dark stores or restaurants and kind of riders. It is a very, very difficult platform to effectively actually disrupt. Eternal, I think, is clearly showing tremendous levels of execution. If you look at kind of Zepto's numbers, the kind of lead that Blinkit has actually taken when it comes to quick commerce is really quite commendable. They are quite clearly leaps and bounds ahead of the other players in terms of just growth, market share overall, kind of the number of stores, the efficiency with which these stores are operating at, etc. Quick commerce continues to be a very, very interesting opportunity. Now, Swiggy, on the other hand, is also, as in they do continue to kind of catch up in terms of their food delivery business. I think this quarter was slightly weaker than the trends you've seen in the past few quarters. But profitability on kind of food delivery is clearly catching up in terms of the gap that they have had with Eternal. The key call when it comes to Swiggy is really about Instamart, because there is a very considerable kind of difference between overall profitability levels, very high cash burns that Instamart still has as compared to a Blinkit, which is broken even. Now, because of that, Instamart is largely trading at virtually no value. If you're looking at kind of Swiggy's market cap, you could pretty much attribute an entire market cap to its foods business. If they are kind of able to turn around Instamart, and I think they did give some quite clear guidances around what they are expecting in the recent analyst meet, there could actually be quite decent and positive surprises that actually come through. So Eternal continues to is really the kind of benchmark in terms of performance. We believe should continue to be a very interesting kind of compounder in terms of long-term value. Swiggy could actually be a very interesting dark horse if they are really able to turn Instamart around. But it is a space that we continue to like quite a lot, and it's really the biggest exposure that we have in our digital portfolio.
From what I see, Ashi, Paytm, while of course it was a strong beat pretty much across parameters from Paytm, but clearly the bonus issue hasn't deterred your opinion on the stock. It's made very, very good a comeback in the last 1 year. Where from here, and what sort of tailwinds do you think are still in place for Paytm?
Sure. So I think at Paytm, right, and this is what we believe markets may actually really be underestimating, is the payments business is really kind of a loss leader. And it actually makes profit. It's not even that it's making losses, but the true kind of value in Paytm is the fact that you can actually sit and cross-sell a whole host of financial services to a segment of India that was otherwise completely unbanked and underpenetrated in terms of access to financial services. The cost of delivery of financial services via a payments app is so much cheaper, and therefore the ability to kind of target micro loans, loans of different types, potentially even moving to a secured credit, capital markets, insurance. There's just multiple ways to which you can monetize a consumer base which is active in terms of which is active on the app because they use it on a daily basis to make payments. So financial services is clearly the very, very interesting longer term value creation. And we think we're still at very nascent stages there. But even on the core payments business, there is kind of talk around MDR coming in on kind of UPI and it may kind of come in slowly. But that could actually even turn the payments business becoming highly profitable. If you look at kind of global payment companies, they make a tremendous amount of money even on a core payments business. So I think fintech is clearly quite interesting. Paytm, Policybazaar, these are all companies that we like. And the same underlying trend across industries, we're seeing a tremendous amount of value creation away from traditional businesses towards these new age digital platforms. And that's really the core of our digital disruption portfolio.
A larger pool of consumer tech, Ashi, and I mean, Meesho, Urban Company, Nykaa, this space is really broadening. But from within these and the earnings that they've delivered, anything that stood out?
So I think pretty much all of them, right? So if you're looking at Nykaa has consistently been kind of delivering, and they've been consistently delivering in a kind of an environment where overall consumption and discretionary consumption has been quite weak. That kind of supports this overall value migration that we are talking about from traditional towards kind of new age platforms, which can really open up new markets. Meesho, I think, is quite an incredible company. It's literally kind of a business model which is, created in India for the Indian consumer. And it's really getting an entire class of society that would have probably gotten to e-commerce significantly later, way earlier than what they would have expected. The business model is really attractive, and I think they still have a large room to grow. Not necessarily so much in terms of number of active users, because that is already very high on the platform, but frequency is increasing quite strongly, and therefore that looks really quite interesting as well. Coming to kind of Urban Company, I think their core business is something. Urban Company is really interesting because they've solved something which is really actually quite challenging. The ability to get trained manpower across a host of different services. So when the traditional kind of services are kind of growing quite well, I think Insta Help is really the big call, right? It's kind of like where quick commerce was a couple of years ago. Tremendous amount of cash burns that you're seeing into a business that could become potentially very valuable over the longer term. So I think when it comes to so out there, really Insta Help is a whole new segment. But in an economy and in a market where you are seeing people struggle for kind of growth, every single digital platform is kind of growing at a very healthy clip. And this reflects our kind of that same underlying thesis that value migration, digital platforms are a lot more efficient at being able to deliver goods and services to the end consumer. And as you kind of go year by year, and especially as the next generation, which has come in born digitally native, as they come into the core consumption class, we believe this trend will only accelerate. And that really drives this overall kind of optimism, and which is where consumer tech, fintech, quick commerce, we kind of like all of them.
Ashi, also, I'm curious to know, because you're so well clued on to technology and how it's evolving, give us a sense. Do you believe traditional IT will likely get phased out by AI, or is there a different view you have there?
We would significantly hope not. And I think the core view here, and if you just go back to any major technology revolution, right? Every single technology revolution which has led to a dramatic reduction in the cost of services, you've seen tremendous new demand actually come in. A very simple example is kind of when you've moved from photos from film to digital. Just look at the number of photos people take today. We wouldn't be taking those many photos if we were still using film and having to pay for film. So as AI dramatically reduces the cost of software development, we believe the amount of software being developed will actually increase quite substantially. And that is why when we talk of IT services, we really talk of, yes, there's a deflationary impact, but the core call is going to be how much do volumes increase. At a level, we don't really see companies reducing IT spends very significantly. And therefore, as long as overall IT spends remain the same, it may not actually end up being as bad for IT services as a number of people believe. We believe there still will be value in IT going forward. Just how large these companies are going to be and how big the demand response is going to be, that really is effectively the big call, and it's a slightly difficult call to take at this point in time.
And Ashi, I mean, while we're winding down to close, last minute or so, I mean, thereafter, it'll be completely the cash segment which will drive the market and the direction. We'll wait for some of those moves as well. But Ashi, while we're at it, within the entire ecosystem, right, AI, data center and the like, where's the best opportunity? Where's the best risk reward at this point of time? How do you place your bets?
So actually, so we like digital. The second big and really interesting opportunity is in this entire artificial intelligence spends. $1.5 trillion being spent just on AI data centers globally over the next couple of years. Now, unfortunately, India doesn't really participate in this entire computing part of the value chain. We are a lot behind peers like Korea, Taiwan, etc. So for a lot of our clients, we're actually very actively recommending international allocations moving towards Korea, Taiwan, and big tech in the US. We believe that increasingly is becoming more and more relevant to be a larger part of portfolios and just not small diversifications. But AI is also throwing open some very interesting opportunities in the electricity value chain in India. There are quite a few interesting companies that are actually suppliers into major global electric MNCs. And that segment is actually is booming like crazy. There are shortages across all parts of the AI value chain, and we all hear about chip shortages and memory shortages and all of that. But electricity shortages are also very, very considerable. And therefore, as part of this electricity value chain, be it generators, be it turbine makers, be it kind of suppliers into fuel cells, this entire space is likely to be in a multi-year structural upmove. And therefore, for people seeking to kind of participate in this kind of decadal, once in a kind of generation AI capex that is happening, yes, there are very interesting opportunities overseas, and we believe investors should look at a certain amount of international allocation, look at Korea, look at Taiwan, look at the US. But there are also some very interesting opportunities coming out here in India. So I think that is one of the other big areas we've been allocating incremental capital towards, this entire kind of electricity part of the AI value chain.
Any names there that you'd like to recommend, Ashi?
I'd ideally not like to, primarily because some of these are much smaller or they're more mid-cap names, etc. We are partly still building out positions, and it's easier to talk about large caps than some of these. So sorry, can't mention specific names, but I think the space itself is interesting, right? And it's kind of a rising tide which should lift quite a few of these boats.
Understood. Ashi, we'll let you go on that note. Thanks as always for joining in. Counting down to the week's close, and we've managed to end the week at least in the green, gaining about 1%. And of course, this is building on to last week's over 2.5% kind of move that you saw on the index alone. So we are finally closing in around that 24,600 level. But yes, this week was all about the cash settlement, and that is what really took a larger share of at least the market mind space. Kunal, first week down, does it seem like it's a little easier, this post-market close adjustment?
Yeah, Aisha, it's definitely settling in because, which started off with almost like a 200-point aberration or a deviation. I think yesterday it was just about some 10 points, 20 points into also. I think it's very, very similar. No major change, at least in terms of cash impacting the market as such. So I think this could now probably bring in some sort of normalcy, some stability in our markets, and hopefully I think we fall back into the same method. I think the only deviation which I was mentioning earlier also at the start could be an adjustment in terms of the other strategies which generally play out at the closing from 3 to 3:30 earlier. So I think that's something which we need to see how those strategies evolve. But I think other than that, this could probably soothe the market in terms of reducing the volatility to a larger extent.
Does the move in IT, Kunal, start to get more stock specific? I'm just curious because now you're starting to see a fair bit of divergence. While IT itself hasn't done well today, but TCS is up 3.5%. So just trying to get a sense.
Yeah, it's possible. It could happen, Harsh, because when the sector goes into such a kind of a strong counterbounce rally for itself from 26,000, we almost I think touched 31,000 for the Nifty IT index. So it's bound to be that after hitting a patch of consolidation, the move becomes a little bit more sector specific. But when you see stocks consolidating and going through a time-wise pause for themselves and not going into a major price correction, even with so much of skepticism being built around the IT index, I would still consider that's a very good positive for the entire space. I think one just needs to be a little bit more choosy in terms of which stock to pick, specifically if these stocks go into any kind of a correction or a retracement. But I would be bullish on most of the stocks in the IT pack. I think yes, TCS is one of the few stocks which is more formidable, but I think Infosys at 1180, 1170 mark is also something which looks extremely attractive.
Okay. The other one is Trent, and we've seen a decent correction on that stock price again now, Kunal. We're sub 3,000 on Trent. Good time to probably go long. And should this be more of a medium-term play, short-term? What are the levels one looks out for? Can we see lower levels on Trent, the view there?
So it should be more of a medium-term bet because I think, the impact the stock had seen last month when there was this 10-15% kind of a downtick for Trent post the news flow. I think post that the stock, even though it's gone into a process of a bounce, but likely scenario, I would say that the stock should retest the previous lows, 2,800 approximately, 2,800, 2,850 mark. I would expect at least another 150 point odd correction for the stock because that's generally a scenario where we look at the markets estimating that whether the stock retesting the previous lows, volumes come back in the same manner or not. So in the similar stance, I would sense that Trent at 2,800, 2,850 mark could be a better bet. But yeah, long-term wise, the stock has formed a major base. The recovery which started off for Trent, price adjusted 2,200 levels from previous highs of 5,600, 6,000 plus mark. That major correction is now behind. We are looking at the stock going through more of a time-wise pause. The major support for the stock at 2,200 levels, I think, is established. Long-term traders should try and use this correction to try and dip into and keep on accumulating at lower levels.
Okay. In the meantime, just looking at how the cash settlement is actually taking place and which are some of the active most movers or losers in trade. Well, the Nifty is largely settled in as a trade. Just want to pick up the biggest movers as we see right now in trade. ICICI Bank has taken a knock of about almost 2.5%. Let's check in on what that stock has been up to, what you're seeing on TCS as well in the extended hours. And then, of course, on the likes of an M&M, a Bajaj Finance, which has been a rank underperformer up until 315. Let's see how these stocks are settling in. 3% higher still for M&M. For Bajaj Finance as well, it's been status quo. It's closing in with that 6% off a loss. Kunal, what happens to Bajaj Finance now after today's crack? And, post earnings, you saw a big bout of movement on Bajaj Finance. Do you now get tempted to buy into the weakness? Or you avoid it for a bit because there could be some more sell-off in store?
See, there could be a little bit of more residual sell-off for the stock price, but I would sense closer to 1,050 mark, Bajaj Finance could actually come back into a good buying zone. Remember, I think the stock very recently, I think, came back in towards a breakout. There was this gap up move. The stock moved up towards 1140, 50 mark, and then notched up another 3-4 percentage points further from those levels. And now it's come back towards the starting point of this entire rally, pre the results for Bajaj Finance, which means closer to 1,050 levels for Bajaj Finance. I think it's going to be a good buying territory for the stock price. It could also close in the gap which was created on the stock price, pre-results. And I think generally we've seen that gaps when they get closed after a rally further, that generally is a sign that the stock prices are now cooling off. The momentum, the excess momentum which was built into the stock price has reduced. And now we are looking at more trending natured upside for the stock price. So I think that flurry of momentum which had happened for Bajaj Finance is now behind. And serious traders who are looking at now this is a positional play, they should try to enter into the stock price close to 1,050.
Okay. In fact, let me go across. There's Britannia's con call as well, where Britannia said inflationary pressure on key raw materials continue with wheat, flour and flour prices remaining elevated. Palm oil prices also rising sharply despite the cost headwinds. The company says its diversification strategy is paying off with cakes, rusks, wafers and dairy business delivering double-digit growth. Just before I go to that, Kunal, what's the view like on FMCG? Would you continue to stay away?
Yeah, continue to stay away. I think the only bet over here which looks attractive is Nestle. Tata Consumers, on the other hand, also I think on the short-term chart starts to look a little bit more better because after a correction from 1280 levels mid of May for Tata Consumers, the stock has come back towards 1080 mark. So it's a decent 15%, 17% correction for Tata Consumers. The risk reward now starts to look a little bit more better. The fact that the stock has not fallen the last 2 weeks or so and has been just about hanging around to this 1080 levels indicates that this is a very strong demand zone for the stock price. So I think other than Nestle, if I have to take a bet, Tata Consumers could be the other stock or the other stock in choice.
Okay, Tata Consumers is what Kunal is currently liking. Just want to see where SBI as well has settled in for the day after that over 3% bounce that you had in the stock price. Post its earnings came out. Let's see how in the closing session it's actually panning out. Still closing in with that 1.25% gain is where SBI is. A huge spike and then it got settled in. Kunal, SBI has really been one of the very strong performers this week, whereas you're seeing a completely inverse move coming in on ICICI Bank today. You were earlier observing that money is now moving hands into PSBs out of PSU banks and even NBFCs for that matter. Does it seem like a continued trend? And then would you say that perhaps there could be more of a headroom on SBI than what it's already clocked in this week?
See, it's already clocked in some 6.5% so far this week. It's heading into the first major resistance around the 1100, 1125 mark. If you go back to the weekly charts for SBI, what started off from 2026 start when the stock corrected from 1200, 1250 levels, there was this major gap weakness for a lower gap for the stock price, which was acting as a resistance for SBI. That gap band for SBI is around 1100 to 1125 mark. And that's why I think over the last 1 or 2 days, even though we were expecting the stock to head towards the gap, but we need to see a weekly closing above this gap level for the stock to come back into its own big breakout mode. The best trend or the most recent one which started off at SBI on the positive side was in the second half of 2025 when the stock moved from 850, 870 levels to almost 1200. After that came a patch of price correction and then a consolidation. Now for the trend to resume what started off in 2025, the stock has to break past about this gap resistance. So I'll wait for maybe another week, let the stock cross and close about the levels of 1100, 1125. Once that happens, then I would believe that we can even expect the stock further to try and go back towards its lifetime high levels and make a fresh high.
Okay, that's that on SBI. And with that, let's close in on the week. It's surely been quite, the interesting session with earnings and, of course, cash as well kicking in.